Hello, and welcome to Gentleman Talk, sponsored by Gentleman Apparels. You can follow Gentleman Apparels on Instagram at wear.gentlemanapparels or follow me on Instagram at gentleman_215. All right, Happy New Year, everybody. Today, we're going to go over the balance sheet, what to look for, and also how to filter out stocks using the stock screener with balance sheet data. Then I'll go over a personalized balance sheet and the most common mistake that people make when analyzing their personal balance sheet. So, let's get to it. So right now I'm going to go over the balance sheet. I'm going to be doing the Home Depot balance sheet, and then I am going to show you how to use that data to filter out stocks on your stock screener for your watch list. But first, please hit that subscribe button if I helped you out in any way. Okay, so here we're on Yahoo Finance. You want to go to Financials, and then you want to go to Balance Sheet if this is what you're looking for. As you scroll down, the first thing you see is total assets, total liabilities, and total equity. So your total assets will always equal your total liabilities plus your total equity. That is why it's called the balance sheet. Your assets is anything that you can sell and make money from, usually equipment, cash, inventory, real estate, or land. Liabilities is basically what the company owes out to anyone really, except for shareholders. Shareholders and company ownership is under equity, which is also kind of known as net wealth. If you're looking at the personal balance sheet. All right, so if we dig into total assets, you see there's two kinds of assets: current assets and non-current assets. Current assets can be liquidated, which means can be sold within 12 months. That's usually cash. In inventory, and then non-current assets is anything that takes over 12 months to sell. Usually equipment, real estate, buildings, land, etc. If you want to dig into total liabilities, it's broken up the same way. Current liabilities is anything that is owed within 12 months. Total non-current liabilities is usually long-term notes, items that are going to be paid off over or after 12 months. And then equity, you don't really got to worry about equity, but this is kind of what the stock and company ownership is in. All right, so the first thing I want to look at is current assets versus current liabilities. You always want your current assets higher than your current liabilities. Here you see we had 34 billion in current assets and 25 billion current liabilities. This looks good. That's the first thing I usually look at. The second thing I look at is the non-current assets versus the non-current liabilities. Here we have 32 billion in assets, non-current assets, versus about 40 billion in non-current liabilities. You can see that actually the long-term or non-current assets are smaller than total non-current liabilities, which will give me some question to look into this a little bit deeper. Could be the corona effect. But if you look at the total assets is definitely greater than the total liabilities. So overall, Home Depot balance sheet looks pretty good. Okay, so now how do you turn this data and use it for stock screening or stock selecting? I'll show you right now. I usually use FinViz for my stock screener. You want to go to finviz.com and then click right here on the screener tab. It'll bring you up to this page, and you'll see there's three different tabs: descriptive, fundamental, and technical. I usually like to start out with USA stocks, just because their accounting and audit rules are a little bit more stricter. So the data that we're getting is a little bit more accurate. So you can see right away that's going to knock us down to 6,547 shares. And then if you want to filter out using any balance sheet data, you want to click into the fundamental tab. So here you see we have a whole bunch of stuff we can filter out, but what we're going to look for is just the balance sheet items, which is just the debt to equity, the current ratio, the quick ratio, and the long-term debt to equity. So for me, I don't really like a lot of debt, but some companies use debt pretty well. So this isn't like an overall indicator to get rid of all bad balance sheet stocks, because a lot of real estate stocks or a lot of real estate companies, especially REITs, use debt over equity. But I like to usually start out my debt to equity under 5. But you can go a little bit lower if you need to filter out more stocks. So for this scenario, I'm just going to do under 0.3. You can see right away that cuts this down to 1,028. So the next filter we're going to go to is the current ratio. So what the current ratio does is it divides current assets by current liabilities. And so you always want anything over 1. The higher, the better. So here I'm just going to pick high. That way we can get rid of some more stocks and see which ones are left. Alright, same thing for the quick ratio. The quick ratio is basically the current ratio, but it takes into effect inventory. So this we also want to be high, or over 1 at least. And then the last but not least, long-term debt to equity. And you want this one low. Let's see, I'll do 0.3 again here. See what we got. Alright. So you can see right away that we went from 6,000 stocks or 7,000 stocks down to 644. Now this is only filtering out stocks with low debt, or a high current or quick ratio. So, I mean, this is just a part of filtering out your stocks. Then you can kind of come in here if you want, filter out any price, any volume that you want. That'll lower this number down until you get down to the number that you want, or a good number that you are good with researching. And then technical, this is more charts. You can filter on here to make your watch, or to make this go down, and to basically filter out any strategies between the 20-day, 50-day that you may want to look for. So in total, that is the balance sheet and how to use that data to screen your stocks for your monthly watch list. Next, I'm going to go over a personal balance sheet and the number one common mistake that people make when analyzing or building their balance sheets. Here I have a personal balance sheet that I just made up. We'll go through it, but you'll get the point. The first thing I wanted to mention about a balance sheet that I forgot to mention on the previous part of this video was that a balance sheet is at a point in time, and it shows financial strength at that point in time. The balance sheet changes every day. So for instance, in this example, we have cash of $2,000 on 12/31/2020. But after this day, this cash will be changed if you spend cash or if you receive cash in. So on 1/1/21, if you spent cash, this cash will go down. If you receive cash, this cash will go up. So that will change. This will change every day. That's why this is only at one point in time, one date. If you look at the income statement, that shows performance over a period of time. So you'll see that one's either quarterly, yearly, or monthly in that case. But just to give you a review of a personal balance sheet, you can see we have cash, dividend stocks, rental real estate, a business, and then a home, which totals $439,500. And then on the liability side, what we owe, got a credit card of $5,000, a home mortgage of $175,000, rental mortgage $190,000. Your car loan and student loans will give you a total of $395,000. for a grand total net worth of 44,500. So what your net worth is all your assets. Well, after you sell all your assets and pay off all your liabilities, what do you have left? In this case, we have 44,500. All right. So the one most common mistake that people make when, I guess, starting out their financial life is a lot of people like to buy their home, which seems like a smart idea, right? Because you're buying assets. But is it a cash generating asset? Is the question. Now we're gonna go down these assets and ask yourself this: cash. Is cash a cash generating asset? Well, of course. If you leave cash in your account, you get interest. That's creating cash or generating cash. Dividend stocks, every month or every quarter or even every year, if you hold dividend stocks, it'll create cash for you. Rental real estate and business, almost the same thing. If your business is profitable, you're generating cash. Same thing with rental real estate, but for the most part, your rental real estate should be profitable. And then when you get to your home, right? A lot of people buy their home because it is an asset, but it's not a cash generating asset, right? So with the rest of these assets, cash is basically coming back in, and you're building up your cash pile, right? So if you get 1,000 from dividend stocks, 1,000 from real estate, and 1,000 from your business, that means your cash is going up from 2,000 to 5,000. But for your home, you're not necessarily receiving any cash for it. That's cash going out, right? Because you have to pay your home mortgage. Unlike your rental mortgage, you do pay it, but you get rent from hopefully your tenants that will pay off this mortgage, and then the rest will go into this cash. So now after a month, now this is up to 5,000. So that would be the number one mistake for people when starting their financial journey, is buying their home first, because that is just draining their cash, their monthly cash flow out of their pocket. Now I didn't make that up myself. You can read the book Rich Dad Poor Dad. That's kind of where I got this concept from. But the overall concept is basically just to recycle your money, and don't let money go out the door. You want to build your assets for money to come in the door, not out the door, like a home. Well, I hope you learned something. Please like this video, subscribe, and until next time, see you later.